U.S. consumers continue to deal with higher prices. The CPI index climbing 0.4%, higher than the 0.3% that was expected. Karina Mitchell is in New York City with the details.
Yeah, so that headline number was estimated to come in at 3.6%. It was really shelter costs that accounted for more than half of the gains on the index, up by 0.6 of a percentage point for the month and up 7.2% year over year. Gas and oil prices also helped push that index higher. But while that headline CPI number was hotter, core CPI, that's when you strip out volatile food and energy, that was actually right on target. So it was up 0.3 of a percentage point for the month, up just 4.1% year over year. And that number is actually better than last month when that number came in at 4.3%. So it's trending lower in the right direction. And that's something, that core number that the Fed watches very closely. But what it really uses as its gauge of inflation is the PPI number. That's the producer price index. And that for the third straight month came in hotter than anticipated last month. So with all of this alphabet soup of data out there, what does this Fed really do when it comes to future rate hikes? When will they begin cutting rates? And then what is their broader story when it comes to inflation? Those are some of the questions that I posed to Mark Hamrick, an economist. Here's what he had to say based on his team's analysis.
First of all, with interest rate cuts beginning next year, not sort of taking the bottom out of the interest rate floor, but modest adjustments, taking them to a lower level. At the same time, they don't see inflation settling into the Fed's 2% target, broadly speaking, before 2025.
So he said, don't look for 2% inflation to come around anytime soon. And he said what we're seeing now is this normalization after the financial crisis, where we had this, situation where we had close to zero interest rates. That's not going to come back anytime soon. So the question then becomes, do we see a rate hike in November? Hamrick said that the Federal Reserve realizes that they're very close to the peak and that they don't have too much room to go to further increase, interest rates. So we'll have to see what happens there. Based on the data today, there's just a 10% likelihood that we do see a hike in November. And even some of the Fed members are sort of on the sidelines or divided about what to do. Fed's Chris Waller says that we should have a wait and see attitude and that financial markets, the bond market in particular, may do some of the central bank's work for it. So we'll have to wait and see. Karina Mitchell, CGTN, New York.
And the market response, John Terrett has that from the New York Stock Exchange.
On Thursday on Wall Street, the markets were all over the place. It was a roller coaster ride after CPI, the Consumer Price Index, or inflation paid by Americans in the stores and the gas stations and in the service industry as well, came in hotter than expected. Now, that is to say, at 0.4%, it was hotter than we thought it would be, but it was still down on the previous reading, a bit like PPI was on Wednesday. So the markets didn't really know what to think. They were looking for a direction, and they saw weakness pretty much everywhere they looked. However, having said that, that CPI is seen here on the trading floor as Fed-friendly, meaning, in other words, it doesn't really move the needle on what the Federal Reserve may do when it meets to discuss interest rates next on the 1st of November. The feeling here is there'll be a pause, and then it'll be a toss of the coin, depending on what happens when they meet again in December. Anyway, on the Thursday session, the Dow was down 0.5%, the Nasdaq and the S&P down by 0.6%. Tech had been up earlier on in the day, but rolled over as the day went on, and financials were lower on the S&P 500 ahead of the beginning of earnings season. And that's the big news for Friday, because third quarter earnings season is here proper now, kicking off with the big banks, JP Morgan Chase, Wells Fargo, Citi and BlackRock. And we also have earnings from the big healthcare company, United Health. All of that to come later on Friday. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For more on all this and what to make of the U.S. economy, we're welcoming back Ted Rossman, Senior Industry Analyst at bankrate.com and creditcards.com. Good to see you again, Ted. I think the last time we spoke, we were kind of talking about the same thing and surmising as what the world looks like. And here we are. I thought things were better. I thought the CPI numbers, for the most part, were in line with estimates. What was the problem today?
There continues to be a lot of conflicting data, or maybe to put it a little differently, inflation is coming down slower than we all had hoped, the Fed included. Now, no doubt we're moving in the right direction, but I think certain aspects here are remaining stickier than expected. One that really stands out to me is housing. Remember for quite a while now, probably about a year now, people have been saying, oh, don't worry about it. We're going to lap the increases. It's going to come down naturally. That doesn't seem to be happening. I mean, it's definitely a very tight housing market, both for purchases and for rentals. And in fact, you would think that mortgage rates pushing 8% for the first time in a quarter century would be denting the housing market even more. But I think low inventory is keeping prices high. Rents are high. I think that's probably the biggest thing squeezing households right now. And it's proving to be harder to stamp out than the Fed
I mean,
expected.
isn't the jobs thing having a huge impact? If you want home prices to come down, I know this sounds terrible, but if you've got full employment and everybody's working, if they can pay the mortgage, they're going to pay the mortgage. They're not going to sell their house. So the only way for home prices to go down is to have job loss, which again sounds terrible, but that's just how the economy works.
The last jobs report was stronger than expected. There are still about 1.5 open jobs for every one person looking for work. All of a sudden, wage growth is actually outpacing inflation. So there is actually a lot to like about the job market, arguably even too much from the Fed's perspective. I mean, the job market's still quite robust. We love that as workers. But what's so interesting to me, too, is that disconnect between a very strong job market and very low consumer confidence. I mean, it's come off the floor. It's not as low as it was in the summer of 2022. That's when it really bottomed out. But still, I mean, today's reading is still vastly lower than most of what we've seen over the past decade and a half. So I think it shows that inflation is squeezing people. They're not feeling great about things, but at least the strong job market is keeping people afloat.
Right. So we all want to complain about how pumpkin spice latte is $7 each, but you're still paying, you're still buying it. We're just complaining about it. And that leads me to my other point is we've been hearing that the consumer is being strapped. Student loans, they got to pay this, they have to pay that. And all these things about the consumer, every data point that I've seen thus far has not proven that the consumer is going to cut back on anything. In fact, in the latest report, you saw that airfares were actually going up, hotel prices were going up. These are all the fun things in life.
There still is tremendous pent-up demand for travel, dining, concerts, sporting events. I think some of that relates to the pandemic and people feeling like they missed these experiences and they're still craving it. I mean, people have shifted some of their spending away from goods and towards experiences, but even physical goods like holiday shopping. A lot of the holiday shopping forecasts are for something like a 4% rise over last year. That's what MasterCard and Deloitte and others are saying. That's more or less in line with inflation, so it's not a blockbuster expectation, but still, it's not like it's negative. I mean, people are still buying stuff, and I think the job market deserves a lot of credit. We are, though, seeing some warning signs emerging, especially among people with lower incomes and lower credit scores. Credit card debt's going up, credit card delinquencies are going up.
Well, I was going to ask you this.
People are viewing it as normalization, but we'll see what comes next.
Well, Ted, I was going to extrapolate on this. Tomorrow we have these big bank earnings from major banks who are going to talk about the health of the consumer. You're in the credit card business. You're in the bank business as well. Are you seeing a significant amount of data that points to a weakening consumer, not just on the low end, but consumers in general?
I think the credit card market is still strong. In the first half of the year, according to Equifax, originations fell ever so slightly, 0.7% from last year's record amount. We're seeing a little bit of credit tightening. We're seeing delinquencies go up a little bit, but so far that's really in line with historical norms. The rise has started to steepen, though. I think what's going to be interesting is, does it level off from here, and do we kind of plateau at a delinquency level that was more or less 2019 levels, which wasn't so bad, or does it continue to increase beyond that? I actually think the answer probably lies in the job market, because that's the biggest predictor of whether or not people are able to pay their bills. So I'm actually still cautiously optimistic about the whole soft landing situation. But it's also a tale of two cities, right? I mean, you have a lot of inequality in the economy, and you have certain groups faring much better than others.
That's true. That's true. Very good points, Ted Rossman. Appreciate your time on this. See you again soon.
Sounds good. Thank you.